Dividend stocks are a great way to build wealth, but not all dividend stocks are created equal. You have dividend growth stocks. These are companies that are growing their dividend at a rate of 10% or more per year, and you're also getting that stock appreciation growth potential. You also have moderate dividend stocks. These are companies like Johnson & Johnson, Pepsi, Coca-Cola. All of these companies are much more mature companies. They're still growing their dividend at a moderate pace, and you're getting a moderate dividend yield, somewhere in the range of, say, 2 to 4%. And then there's the high yield dividend stocks. These are companies, think of something like a REIT or slower growing dividend paying stocks. You're going to get a dividend yield that's above 5%, but the dividend growth is going to be much lower. I get this question all the time, and just because a dividend stock pays a high yield doesn't necessarily make it a great investment. There's what is called a yield trap. This is where you'll see, say, a 10-15% dividend yield, but the payout ratio is well over 100% and the dividend is just not sustainable for the company. As such, in today's video, we're going to take a look at five of the best high quality dividend paying stocks that are out there today. All of these are, again, high quality businesses with wide moats. They are leaders in their sector. They have strong management teams, strong balance sheets, and they have stood the test of time. No matter the economic backdrop, these companies can still perform over the long term to help increase your dividend income for years to come. So make sure you watch all the way through the entire video, because at the very end, we're going to have a bonus pick as well. Hey guys, Mark here again, and we are bringing you a jam-packed video today discussing some of the top dividend stocks that are out there for almost any dividend portfolio. And if you haven't checked out my latest dividend portfolio, then after this video, down in the description below, I will put a link to my latest dividend portfolio update. Pretty pleased so far with the dividend portfolio, as we are outpacing the S&P 500 thus far. One reason that I love dividend stocks isn't just for the passive income that increases each and every year. It is that I believe that dividend stocks truly are a total return investment. You're going to get stock appreciation as well as actually earn investments, earn your income and your right as a shareholder in that company. Because again, if you're invested in a growth stock and it shoots up 200%, but then falls 200%, you have nothing to show for that. That was all just fake paper money. But with dividends, you're actually going to receive some of the profits from the company. Because again, when you make an investment in any stock that is out there on the market today, you become a shareholder, which means you are now an owner of that business. And with dividends, I like to think of it as earning money while I sleep. But before we get started, if you can do me a huge favor and click that like button down below, that is huge for the growth of this channel moving forward. Plus, if you like the idea of dividends and passive income and want more of this great content, then make sure you subscribe to the channel and click that notification bell so you are notified anytime we drop a new video. And also, I have a great new promotion for you right now from Webull. And this is just going on for the next 2 weeks through the end of August. If you sign up for a new account at Webull and invest or deposit any amount of money, you can invest a quarter if you wanted to, $5, $500, whatever you want to do, just invest and deposit any amount of money in this new account, and they will give you up to 12 shares valued up to $30,600. Make sure you use the link down in the description below. This day and age, when it comes to investing, too many people get bogged down on how many shares they own. But remember, it's about how much you invest. Let's say that you buy 100 shares of a stock that's trading at $100 per share. If you multiply that out, that means you invested $10,000. Now, if you also invest in a stock, let's say you buy 5 shares of a stock that is trading at $2,000 per share. That also equates to a $10,000 investment. One company you have 100 shares in, the other company you have 5 shares in. Nonetheless, you have $10,000 invested in each of these companies. If they both go up 10%, you are going to make $1,000, regardless of the amount of shares that you own. So again, focus more on how much you're investing in a particular ETF or dividend stock or any stock really, rather than worrying about how many shares you own. And to be successful when it comes to investing, especially dividend investing, you really want to be able to put your money to work and be patient and allow the power of compounding dividends to take over. Again, when you make that investment, you are truly now an owner in the business. So with all that being said, let's now dive in and take a look at 5 of the best dividend stocks that you could buy and add to your portfolio. The first company that we're going to look at today should come as no surprise, and that is Apple, stock ticker AAPL. Apple currently has a market cap valued at $2.8 trillion, making it the largest public company or the largest company in the world today. If you want to make money in investing, focusing on the best companies that are out there is a tried and true way of making money long term. And Apple fits that bill. They have been able to innovate for years and have really transformed the company into strictly being a consumer hardware company to now building a massive service company or software company as well. Not only do they have things like iPhone, Macs, Apple Watch, AirPods, and many other products out there, it is all backed up by service revenue now. They earn money through iClouds and other subscriptions, getting insurance on products, and they're even looking to roll out a new subscription model as it pertains to the iPhone, which will have a new iPhone in your hand almost every single year. When you look at various S&P 500 ETFs, technology ETFs, growth ETFs, dividend ETFs, one name that you will find most common amongst all of those is Apple. And this isn't just because of its cool products. It's because they have been able to consistently generate higher revenues and higher cash flows, which has now given them a mountain of cash. Not only do many around the world believe that Apple is one of the best companies, if not the best company in the world, but Warren Buffett himself has made Apple account for 40% of his Berkshire Hathaway portfolio. As of the latest 13F filing, Berkshire once again added another 3.9 million shares of Apple, which brings them to a grand total of nearly 895 million shares of AAPL. Now we know that Buffett has loved dividend stocks over the years, and Apple is a great dividend stock in itself. It has been increasing its dividend now for over 11 years. Apple is still a fairly new dividend payer, but I believe they are just in the early innings, and they are going to make for a great dividend growth stock for years to come. Although the yield is very low, but it's not due in part to slow dividend growth, because over the past 5 years, Apple has increased the dividend close to 9% per year. The growth in Apple's share price has outdueled the dividend growth. Remember, a higher stock price equates to a lower yield. Apple is a must-own stock for any portfolio as they continue to innovate, grow their service revenue, which has very high margins, which should fuel a growing dividend for years to come, making Apple an up-and-coming dividend aristocrat. The second highest quality dividend stock to own in your portfolio is Microsoft Corporation, stock ticker MSFT. Again, like Apple, Microsoft is one of the most well-known companies across the globe and one of the largest. In fact, they have a market cap that sits right now at $2.2 billion. We already discussed Apple being a technology company, but Microsoft is also a technology company, but vastly different. Microsoft owns the popular Windows and Microsoft Office platforms. Think of Excel, Microsoft Word, PowerPoint, but they're also involved in gaming, and they are a dominant force in cloud. And with so many businesses and folks moving to the cloud, Microsoft is one of the 3 largest cloud providers on the market today. The other competitors include the likes of Amazon with AWS, as well as Google Cloud. But Microsoft's Azure has consistently been growing. And if you look at this chart here, you can see that Azure has grown on a quarterly basis 50-60%, but as of the most recent quarter, we saw that grow only 40%. So it is still growing at a very rapid pace. Microsoft has also benefited from having more of a subscription-based offering. They've moved a lot of this Microsoft Office to online and making it, say, a 12 or 24-month subscription, adding more reoccurring revenue for the business and locking in clients longer term. This has all helped fuel the company to be able to increase its cash flow, which in turn has increased its dividend for 20 consecutive years and counting now. Microsoft has also blown past a $200 billion run rate in terms of revenue over the past 12 months and moving forward. And analysts are looking for $220 to $240 billion in the coming years. All of this leaves Microsoft with a long runway of growth, especially with the strength we are seeing with Azure and their cloud service. And in turn, this will fuel a growing dividend. As we've seen over the past 5 years, Microsoft has increased their dividend at a rate of 10% per year moving forward. But like Apple, Microsoft shares have been performing quite well over the years, so that yield still sits right below 1%. Again, Microsoft is such a high quality name. They are found in many different ETFs out there. They're found in obviously S&P 500 ETFs. They're found in dividend paying ETFs, growth ETFs, technology ETFs, you name it, because this is such a well-run company and a high-quality company paying a very safe dividend, growing dividend at a low payout ratio. So definitely take a look at Microsoft for your dividend portfolio. The third high-quality dividend stock that we're going to look at today is one of my favorites, and that is Johnson & Johnson, stock ticker JNJ. Johnson & Johnson is a global pharmaceutical giant with a market cap sitting at $436.7 billion. The company operates in 3 different segments. You'll have the pharmaceutical segment, you have a medical device segment, and then you have the consumer health segment. This is the one that many of you are familiar with, as if you go across households all over the globe, chances are you will find at least one Johnson & Johnson product in there. Some of these products in the consumer health segment include the likes of Band-Aid, Listerine, Motrin, Tylenol, Neutrogena, Aveeno, Johnson's Baby, and so many more. But this is exactly what makes Johnson & Johnson such a reliable company. They're not the likes of Apple and Microsoft, which we just took a look at in terms of growth, but they are there in terms of consistency. No matter the economic backdrop, people need these products that Johnson & Johnson has to offer. Regardless of if we're in a recession or we're in a booming economy, your headache doesn't care. So you still need Tylenol. The scrapes that your kids are going to get, it doesn't matter. They're not going to come more in a recession or less in a recession. You're still going to need Band-Aids regardless of the economic backdrop. This is why Johnson & Johnson is relatively a recession-proof company. It may fall, but it's not going to get hit as much of these high ultra-growth stocks are going to get. And when the economy is booming out of control, it's not going to grow as fast as some of those ultra-growth stocks. It's going to be your consistent, moderate grower that's going to pay a solid and safe, growing dividend for years to come. Across the globe, we are getting more people that are living longer, which just further adds to the long track record and long runway that Johnson & Johnson has moving forward, only further increasing its total addressable market. In terms of the other 2 segments in Johnson & Johnson, you have the medical device segment as well as the pharmaceutical segment. Both of these are much faster growing segments for Johnson & Johnson. And recently, at the beginning of this year, Johnson & Johnson announced that it would be splitting up the company into 2 separate companies. They were just getting too big, and this would unlock further shareholder value as it would allow executives to focus on the faster growing segment and separate executives to focus on the consumer health segment. Although Johnson & Johnson does not grow at the pace that it once did, it still offers consistent dividends, it offers growing dividends, and consistently growing revenues and free cash flow. Speaking of the dividend, J&J shares pay an annual dividend of $4.52 per share. This equates to a dividend yield of 2.72%. The company also has a low payout ratio of only 43%, which should speculate and have plenty of room for further growth moving forward. And even more impressive is that the company has 60 years of consecutive dividend growth, making it not only a dividend aristocrat, but a dividend king. Having over 50 plus consecutive years is what makes you a dividend king, and Johnson & Johnson has 60 now. So definitely take a look at shares of Johnson & Johnson for your long-term dividend portfolio. The fourth high-quality dividend stock to consider forever in your dividend portfolio is Realty Income, stock ticker O. Realty Income is a real estate investment trust, or REIT. REITs own real estate property and lease them out to tenants. They also have tax advantages to where they're not taxed at the corporate level and is more a pass-through entity, but they have certain rules that they have to follow in order to maintain their REIT status. And one of those rules is that they must pay out 90%, at least 90% of their taxable income to shareholders in the form of dividends. What this means is REITs typically have higher yields than regular dividend-paying stocks that are non-REITs. And in discussing REITs, Realty Income is one of the most popular that is out there today, especially with retail investors. They are known as the monthly dividend-paying company, and this is pretty self-explanatory because they pay, instead of a quarterly dividend, which many dividend-paying stocks do, they pay every single quarter. What Realty Income does is, you guessed it, they pay a monthly dividend. And the company actually trademarked the term the monthly dividend-paying company. Realty Income has over 11,400 properties with a portfolio occupancy rate of 98.9%. In fact, that occupancy rate has never fallen below 96%, which is quite impressive. 1,100 different tenants within the portfolio, and that is throughout 72 different industries. They are not just here in the US. In fact, the company has nearly 200 properties overseas. Looking more closely at the portfolio, you can see that the largest exposure is to the grocery industry, which accounts for 10.5% annual base rent, or ABR, followed by convenience stores, which account for 9.2%. The company's top client is Walgreens, which accounts for 4% of the total ABR, and other notable top clients include Dollar General, 7-Eleven, FedEx, CVS, Walmart or Sam's Club, Tractor Supply, and Home Depot, just to name a few. The portfolio is split up into 3 different types. You have retail, which accounts for 84% of total ABR, industrial, which accounts for 14.3%, and other, which accounts for 1.7%. Most recently, the company got into the gaming industry. Realty Income isn't just one of the most well-run REITs and the gold standard for the REIT sector. They're also one of the very few, not only in the S&P 500, but also on the Dividend Aristocrats list, meaning the company has paid a growing dividend for 25 consecutive years or more. Not only has Realty Income paid a growing dividend for 25 consecutive years, they have paid 625 monthly dividends with 99 consecutive quarters of increases. So not only are they increasing their dividend on an annual basis, they're actually increasing their dividend on a quarterly basis as well. But when looking at REITs, we don't look at EPS. Instead, we look more at cash flows and more focused on funds from operation, or FFO. And in terms of Realty Income, revenue and FFO has helped fuel this growing dividend over the years. The company is also backed by a very strong A-rated balance sheet. And if you're looking for real estate exposure, and in particular REIT exposure, look no further than the monthly dividend paying company in Realty Income. The 5th high-quality dividend stock that you can hold in your portfolio forever is Proctor Gamble, stock ticker PG. Procter & Gamble is a global consumer goods company with a market cap of $355 billion. Similar to what we saw with Johnson & Johnson, Procter & Gamble also has products that you can find in most households found around the United States. Think of things like soap, toothpaste, toilet paper, laundry detergent, hair products, razors. These are all products that are needed forever. Also, like Johnson & Johnson, Procter & Gamble does not grow at the same pace it once did. It is a much more mature company now, but it grows at a more consistent rate. And when you are a dividend investor, you want to have a good mix of dividend growth stocks, but you also want to have a fallback and looking for those consistent companies that are going to be able to increase their dividends consistently and also be able to perform regardless of the economic backdrop. And that's exactly what you get with Procter & Gamble. Speaking of consistency, Procter & Gamble has increased their dividend for 66 consecutive years. The current dividend sits at $3.65 per share, which equates to a dividend yield of 2.46%. The company has a 60% dividend payout ratio, meaning there is plenty of room for further growth moving forward. In terms of dividend growth, over the past 5 years, Procter Gamble has increased their dividend at a rate of 5.6%. If you're looking for a company that has stood the test of time, that is going to consistently pay you a dividend, a safe, reliable dividend that will grow at a moderate rate, then look no further than Procter & Gamble. So there we just looked at 5 individual dividend-paying companies, some of the most high-quality companies that are out there today that you could literally buy and hold forever in your dividend portfolio. These are some of the highest quality stocks around. They provide dividend growth, and more importantly, they provide dividend reliability. There's nothing worse than seeing a dividend cut. Now, let's take a look at a dividend-focused ETF. When building out a reliable, sustainable portfolio, it is important to have a very strong foundation. I always get the question is, where do I start with investing? And I always believe that investors should start by building out a strong foundation. And that includes ETFs or index funds with S&P 500 exposure, or total market exposure, or even dividend-focused ETFs. And that brings us to one of my favorite, if not my favorite, dividend-focused ETF that is out on the market today, and that is the Schwab US Dividend ETF. This is a broad-based dividend-focused ETF, stock ticker SCHD. This is a ETF that I try to add to regularly. It's broad-based. It focuses on dividend growth stocks, dividend aristocrats, moderate dividend, high yield dividend payers. Again, it is very broad-based. SCHD has assets under management of $34.2 billion. And here's a look at their top 10 holdings, which include Texas Instruments, PepsiCo, Coca-Cola, Home Depot, Cisco Systems, Amgen, Merck, Broadcom, Pfizer, and IBM. In total, SCHD has 104 total holdings, but the top 10 holdings make up 41.5% of the entire ETF. So there you have it, folks. 5.5. You get 5 individual stocks, and I also throw in a bonus ETF for that half. 5.5 great positions to buy and hold forever in your dividend portfolio, regardless of the economic backdrop. I've given you dividend growth stocks. I've also given you dividend reliable stocks and even REITs, real estate investment trusts. And then we finish it off with a dividend-focused ETF, which happens to be one of my favorite investments to add to regularly with SCHD. Again, I hope you enjoyed the video, and if you did, please give us a thumbs up, subscribe to the channel, and with that being said, we will see you next time. Take care.